The second quarter GDP numbers are out here in Canada and they came to a bit of a surprise. We're going to figure out just how we got here, what areas of the market are doing well, which ones are suffering a little bit, and then we're going to take a look at what the analysts are saying about the GDP number to come to a final concrete decision as to what the Bank of Canada is going to do next week in regards to the interest rate announcement. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. So if you haven't yet seen how Canada's GDP fared in Q2 of this year, we'll jump over to this Reuters article and we can see right off the headline, it unexpectedly shrinks. So we'll drop down here and we'll take a look at just how these numbers came in. So we could see that the second quarter reading was far lower than the Bank of Canada's forecast for a 1.5% annualized growth. And the analysts had actually predicted a 1.2% growth, but in reality, it came in at 0.2%. It actually contracted 0.2%. So this is kind of the first quarter of negative GDP growth that we've seen in a really long time. So now that we know that GDP came in at such a wide variance as to what was expected, let's break down some of the numbers to see how we got here. So we'll jump over to this TD report and we can see that housing was once again a big drag. It's down 8.2% quarter over quarter. That's new construction and lack of renovation. High interest rates are definitely the factor as to why people aren't investing in these areas anymore. And that is definitely something to take into consideration to potentially what may happen in the future. We have Canadian consumer spending slowed to 0.2% quarter over quarter. Now, if you remember back to the first quarter report, this was actually a huge area of growth within the Canadian economy, and it did 4.75% quarter over quarter in Q1. We did have spending on goods increase by 0.6%. That's expenditures on new trucks, vans, etc., etc. Spending on services surprisingly did not grow as all as Canadians held back on spending abroad and going out to bars. Trade was also a drag. Imports rose, exports decreased. That's a huge, important part of the economy. We want to see Canadian goods going throughout the world. People pay for and bring money into the economy that way. So incomes rose in Canada. Employee compensation surged 9.1% quarter over quarter. This caused the savings rate to increase to 5.1% from 3.7%. Now, realistically, GICs, high interest savings accounts, how could you not want to save in this environment? Whether it's good in the long run in terms of investments is a different story. But I'm definitely benefiting being a saver in this high interest rate environment. Now, it is important to note just on the income facet, I was able to pull out a chart. Got this from Larry Berman, also from LH or Lawrence Summers here on Twitter. And it goes through what the trends are from CPI that we're currently facing today, and that's in the yellow/gold line, in comparison to what inflation was like in the 70s. You know, we are cheering on the Bank of Canada in terms of what they've been able to do to bring inflation down to 3.3% in the latest print, but it is important to note that in 76 to 78, we're kind of dealing with a situation that is very similar, and that is wage growth. If wage growth continues to go higher, then we could see inflation spike its dirty head in a couple years' time. Now, we have unions striking right now, and this is very similar to what happened in the 70s. Unions went on strike. They saw inflation was taking away their buying power. What they did is they decided to demand higher wages, which we're seeing today, whether it's UPS, Port of Vancouver, Metro that is currently under negotiations. We have so many of these companies and unions that are pushing for more wages essentially. And what happened in the 70s, later 70s, is that everybody started to see the unions were getting money then and everybody else wanted a wage increase. So that's kind of what happened, and a concern down the road to see if inflation will spike again. So just something I wanted to throw on your radar. Definitely something of interest, but more importantly, let's go back and take a look at what some of the analysts are saying. So we'll jump over to this Financial Post article. And Tiago Figueiredo of Desjardins said the GDP numbers reinforce our view that the Bank of Canada is done hiking. We talked about it in last week's video. This GDP number was going to be a huge determinant of what the Bank of Canada was going to do. And this says it all. The economy contracted in the second quarter, which is probably what they were expecting. But in reality, there is no need for future rate increases. Let's see what some more analysts are saying. Douglas Porter from BMO said the broad softening in the domestic economy will almost certainly move the Bank of Canada to the sidelines. Between the half-point rise in the unemployment rate, the marked slowing in GDP, and some cooling in core inflation, it looks like the rate hikes are over and done. We'll jump over to this BNN article. We'll just get a few more opinions just to slam this home. And we can see Stefan Marion said, I do believe they are done with hiking. What we're seeing in this quarter is consumers are reducing their pace of consumption and they're growing their savings rate in anticipation that in the coming quarters, they will need to be prepared for a payment shock. Now, taking that into consideration, now that we kind of have that idea that rates probably aren't going higher next week, what does this mean about the economy moving forward? And we read again from Douglas Porter, it looks like growth is going to struggle to stay positive in the third quarter as well. And this is something that is very concerning because if you have 2 consecutive quarters of negative GDP growth, it is a technical recession. Now, this is something that we have been concerned about for the last couple of videos, if not the last couple of months. It is often, important to remember the stock market is not the economy. Stock market's often future looking, but maybe some of this data has not filtered in as of yet, but that is definite concern. So we know the Bank of Canada is probably most likely, almost certain, not going to move higher next week. But more importantly, what are they going to do in the future to ensure that we don't have multiple consecutive quarters of GDP decline or contraction? Let me know your thoughts down below. Do you still think the Bank of Canada could move higher next week? If not, let me know. Hope you all enjoyed this video. If you like this Bank of Canada, Canadian economy type videos, I'll link a few above and then you can check them out on your own. But I hope you all have a great week in the markets. Happy investing.